we have to figure out what the real influence is from, let's say, huge waves of capital coming into a market that makes it much more liquid, or the other thing, which is all the economic and fundamentals. I mean, honestly, I would never invest in Greece. Who cares about Greece at the end of the day? I mean, there are some guys going there and they make good business, fine, but there is no liquidity in the market. And I do not want to travel there 10 times to find then someone who I can sell for maybe and make a margin of 20 or 30%. This is not interesting. So this is more or less a local play. And I will not say that there are guys making maybe good money, okay. But coming back to Spain, for me, Spain is a guarantee for making money. Why? Because all these guys are there. Because these guys are trying to do some deals, so the market is getting liquid. There's upcoming demand, and there is now, after that Lone Star deal, we have a guarantee for 5-6 years very active trading of real estate, and that is a perfect market. So coming back now, when now the economic, more or less the economics, the fundamentals are in line with a slight increase, and this is what everybody says. The only question is the recovery in Spain within the next 2 years, or takes it 5 or 6 years? I mean, who cares at the end of the day when they have fully loaded bags of billions of portfolios? They have to work with it. And I guess today liquidity is the main factor in such a market. And coming back, I mean, the Netherlands, Italy now, I mean, where else you want to invest? I mean, there are not so many opportunities. And I guess in addition to what we see from the US, I mean, the US market went super over the last 3 years. I mean, 3 years ago, after the crisis, people, I mean, I was now in the south of, in Florida for some months. I mean, no one would have bet on the market coming back within 2 years. The prices are on higher level as they were before, but without any debt. Fully driven by equity. So very healthy market. A lot of money is coming in from the Latin Americans. So what I want to say is the US market is not a cheap one. So now they've made the money there. Now they're coming over, looking very aggressive here in Europe. So Europe fits super in the appetite of these investors. And coming back, I mean, I would go there where the main capital flows are going into.
And when you say it's an ideal time to make money, I mean, you could say it's an ideal time to monetize an asset or sell into the market, but when all those people end up with similar assets which they want to exit within similar time periods, in some ways it's more difficult to predict what the exit value will be, bearing in mind all the sort of euro issues which are still there and the sort of economic issues which are still there. I mean, some of the deals that we've seen done, I mean, are sort of opportunistic or alternatively targeted specifically at an exit down the line into an institutional market. So they're sort of core plus type transactions. And I think the Blackstone deal in Utrecht, you mentioned an example of that, where they bought in at 7%, so a very good yield, but they've taken a view on the tenant extending the lease. But assuming it does extend, and presumably they're fairly comfortable with that based on discussions, that will be a product they can sell down to Becker or Union, whoever it is, down the line as that weight of money moves yield. And again, the deal that London and Regional did in Spain recently, which was quite an old-fashioned deal in some way, like a sale and leaseback with Vodafone, index-linked cash flows, again about 7% yield. You can see how that will really appreciate in value, because the capital that's in Spain targeting assets is not at the moment targeting those sorts of assets. They're all looking for the opportunistic higher returns, and the institutions aren't going into that market because it's not really a market they feel they can go into yet. So,
but this is exactly what is the perfect approach. I mean, if you're going to compare that to Germany, I mean, the first movers in Germany, 2002, 2003, were all the private equities. They went into the market, they had this higher return, and then came this, let's say, second, third, fourth wave, Scandinavian semi-institutions, ultra-high net worth came into the market, and they are paying higher prices based on lower return expectation. As you said, I mean, moving and today, let's say, mismanaged asset in a core plus or whatever core plus, between core plus and value add, brings you an upside of approximately 10 or 20% of the value. And then, I mean, what will support the market in Spain is that currently you see that the debt markets are coming back. And I mean, this is a super thing. I mean, now, what you're going to do now, I mean, if you're going to go for development today in Spain, you more or less have to start it with full equity. You have to acquire the plot on a full equity base. I mean, we have seen that in the US, and there they put in pref, mezzanine types of capital and all that. So that's an interesting structure. But what I, for instance, think that when the confidence is coming back to the market, and you see that there is a liquidity in the market, then the banks will be much more open for higher LTVs, and when that comes to the market, then you will see there will be a lot of trades and people will make a lot of money.
Yes, and also probably Spain we're talking a lot about Spain because Spain, out of all these markets that we just mentioned, like the Netherlands, and we didn't talk about the Nordics yet, but I guess when you say Italy, Greece, Spain, the Netherlands, Ireland, it's very small markets. And to come back again to Spain, Spain is the biggest and the most liquid investment market, or has been historically to the other ones, and certainly considered in Southern Europe the most transparent market, which is the reason why the exit strategy is not only a price strategy, but also a question of will the core funds go into Spain, and they definitely will go into Spain much more easily than go into Greece or go into Italy. But I'm surprised we only talk about these markets where you have a short cycle, where you have short opportunities for the time being to go in and to take an opportunistic view. Don't you think that today the markets such as the UK, such as Germany, such as France, which are the biggest investment markets and the most liquid markets, I think even if we hear a lot about Spain, I think they are the markets which are targeted today by the big opportunistic funds and also by all the others, because they are so deep and because they are so liquid. I don't hear you talk about those markets at all this morning.
And you're completely agree. That's where the transaction volume has been, and I think, notwithstanding the fact there'll be a lot of press coverage around these new markets, yes. I think our view is I think this is there is still a lot to do in UK and Ireland. The point is, can you still call it opportunistic in UK and Ireland? Because actually,
well, it always depends. I mean, if you look at properties within London, in the West End, to be refurbished, restructured, relet afterwards, I think you cannot call that distressed assets. But I think you will. No, you cannot, because I mean the pricing is such, and the demand is such that you don't have only the opportunistic investors, but even the property companies, the long-term investors who would consider that there is no letting risk. So as soon as you have that situation, of course, it's not a distressed asset and it's not an opportunistic pricing anymore. But the markets are so deep, and that's where, let's say, the banks have been lending a lot. And that's where all kinds of investors in the last cycle have been active. And as far as we see, you still find a lot of opportunities in those markets.
No, we're certainly seeing a lot, I mean, of opportunistic money targeting some of these bank auctions, where often through the sort of consensual sale process that Mathieu was referring to, where a seller is selling, but effectively it's a disposal by the bank. And these are usually in the context of opportunistic transactions where there's an operating business as well as real estate assets. And often they're trying to build a platform which they will then exit through whatever process it is, possibly listed down the line or trade disposal. And in some ways, these are themselves a macro play, probably taking a positive view of the economy and the sort of growing economy and throughout the country, and businesses which have been undercapitalised, and therefore where there's significant scope to improve the EBITDA. So when the market's moving positively, you get the double benefit of an increase in the real estate investment yield plus an increase in the EBITDA, for which you then also can apply potentially an increase in the multiplier. Now, for example, take hotels. I mean, they were trading at about a multiplier of 9, say 9 or 10, probably nearer 9 than 10, 12 months ago. There have been deals recently over 11, and there's a couple of portfolios in the market at the moment which are over 12.
Yeah.
And that's all happened in 14 months.